Hey everybody, in this video, I'm going to be going over the basics of group health and accident insurance to help you pass your health or life and health insurance exam on the first try. If you'd like a free study guide, please click the link in the description of the video. It will also be in the pinned comments. Now, I'm going to go over the material here that I've created, and then if I can help summarize it in a way that's easier for you to understand, then I will do that at the end after covering the topic. So group versus individual coverage. Most Americans are covered by group medical expense policies rather than individual policies. A group policy is something that someone gets through an employer or something like that. So it's part of typically an employer's benefit package. So like if you started a new company and they're like, oh, we offer health insurance, that's a group medical expense policy. Individual policies people apply for individually. The primary benefit of group coverage is the lower out-of-pocket cost for participants compared to similar individual plans, even when the plan is contributory. So contributory is when an employer and an employee pay for a plan. Non-contributory is when the employer covers the whole thing. So when your work covers the whole thing, it's called non-contributory. Now, group coverage is typically lower out-of-pocket for people who are insured or the participants because there's lower administrative costs because they're covered under one large master policy, and it's easier, I guess, for the insurance company to handle the administrative charges or whatever. I don't know the exact details, but it is cheaper for a group plan typically than individual policy. In a group plan, if a group member leaves their job, they're protected by the conversion privilege, which allows them to continue their coverage. Group health plans can include a variety of coverages such as medical insurance, disability income insurance, and accidental death and dismemberment insurance, either alone or in combination. It's common to find all of these bundled together in a single group plan. So a lot of times it'll be medical insurance or health insurance, disability insurance, and accidental death and dismemberment. The conversion privilege is when someone leaves their job, they get to keep their policy and get an individual plan. So the employer's role in a group plan includes selecting benefits available to employees, applying for coverage, and providing necessary underwriting information and paying the premiums. So the employer, the person who hires, right, the company, their role is selecting what benefits the employees get, applying for the policy, and providing necessary underwriting information and paying the premiums. So group plans can also offer differentiated benefits, like additional benefits to certain employee groups, like older employees. Okay. Benefits of group health plans for employers. So there's benefits for both the employee. One of them we saw up here, right? How it's usually cheaper. The out-of-pocket costs are usually cheaper. So there are some benefits for the employers as well. So the companies have incentive. Employers, one is morale and productivity. So a health plan can help contribute to a positive work environment and enhance employee performance. It has a cost saving for employees, so employees receive a valuable benefit that they would otherwise have to purchase with after-tax dollars. So when they're paying for a plan through their payroll from work, it's pre-tax dollars. And this helps reduce wage increase demands, right? So it actually can save the employee money, which means that the employee doesn't have to come as much out of pocket, which means they're not going to ask their employer for more money as often. I guess that's the logic here. And then hiring and retention. So it's a bigger incentive for someone to join the company if there is a health plan, right? Hey, we offer benefits. Cool. A great health insurance program. That helps recruit and attract top talent and to keep them there, retain them. And then employers can often claim a tax deduction for their contributions to the plans. Hopefully there's no background noise right now. I have people installing solar here, so there's like drilling cement. So hopefully it's not too bad and I don't have to redo the whole video. All right, so public and employee relations. So providing a health plan enhances the employer's reputation and standing with both public and employees. So they get better ratings, essentially. All right, so health and accident. Cafeteria plans. So employer-provided health insurance benefits are often included as part of a cafeteria plan. Okay, so cafeteria plans allow employees to customize their benefits package by choosing from a variety of options. provided by their employer, like selecting from a menu. So that's why they call it a cafeteria, because there's a bunch of different options. You can pick and choose what you want. Okay, so it's very flexible. Key features include benefit selection, so they can select the benefits they value most and opt out of those that are less important. The employer contribution, so employers allocate a specific amount of money for each employee to use towards purchasing benefits. So they will provide a certain amount of money to help cover those benefits. And pre-tax contributions. So if the cost of the benefits exceeds the employer's allocation, so say the employer says, okay, you get $500 a month towards benefits, then the employee can cover the remaining balance on a pre-tax basis, meaning that they get it taken directly out of their paycheck before their paycheck is taxed. So say they get paid $2,000 a week, and then there's a $300 excess between what the employer covers and the cost of the coverage, right? Then that $300 is taken out of their paycheck before they get taxed. Okay, so I'll show you a little example here. This might help, but let's say this, and if this is really simple for you guys, sorry, I just want to make sure this is clear. So say it's $800 for coverage, right? For everything. The employer covers the $500 that they said they would, leaves a $300 benefit difference, okay? $300 difference. So what happens is this $300 has to come out of the employee's pay. So say they're on a $2,000 a week salary, okay? That means that $300 comes out minus 300, so they are getting $1,700. That's taxed. And then the $17 is times the tax, and I don't know what they would get out in their paycheck. So, you get paid, you get tax taken out, and then you get what you get. Then you get your take home. So essentially, this $300 is taken out of the money that is taxed, not the take home pay. So that $300 would not come out of their take home pay. It comes out of the amount, the total amount before taxes are applied, which means that they actually get, it's a bigger value for the employee, sorry. Okay. So that's called a Section 125 plan. A cafeteria plan is also called a Section 125. They're governed by Section 125 of the Internal Revenue Code, which is why they're called that. Note, an S corp owner. So if you own there's a type of business called an S corp, an S corporation, S corp. If you're an S corp owner who holds more than a 2% stake, you're not eligible to participate in a Section 125 plan. Okay. I believe that means the individual would not be able to get that benefit through the company. Okay, common benefits available under a cafeteria plan. So cafeteria plan, right? You go to the cafeteria, you got your tray, give me some beans, give me some bread, give me some potatoes, give me some turkey and beef. This is what it's like. You go with your tray. You can choose some disability insurance if you want, short and long term. You can choose some medical insurance or health insurance, people call it also. Life insurance coverage, accidental death and dismemberment, and dependent care, so care for people who are dependent on you. Some plans offer more choices within those choices, for instance, allowing employees to select various levels of medical coverage or different HMO. So for for the medical insurance, there might be like a gold plan, a silver plan, and a bronze plan or whatever that you can choose from within that. So it's part of a benefits package. And then when someone starts work, they're like, here's the benefits package, pick which ones you want. Okay. Group underwriting consideration. So and when someone applies for individual health or medical insurance, they're underwritten individually, meaning the insurance company evaluates their eligibility, like just them. But group underwriting is a little different. The whole group is evaluated. Okay. So our underwriters assess a variety of factors to determine whether the group represents an acceptable risk. While some groups may have a member with a higher risk, it's rare for an entire group to be rejected on one high risk, especially if the group is not very small. For instance, say one person becomes a member of the group and they've had cancer, 4 times. Obviously, that's a higher risk that they're going to have to receive or they're going to file a claim for some treatment for something that's very expensive. But that doesn't mean the whole group will be rejected based on that one risk, especially if it's a big group. So the considerations for most types of group policies are the reason for the group's existence. So the group can't be formed just to obtain insurance. So it has to be formed for some other reason other than obtaining insurance. These are all to help protect against adverse selection and lower the risk for the insurance company. If the group was only formed for the purpose of getting insurance, most of the people in the group wouldn't be healthy. So stability of the group. So they prefer groups with stable membership and low turnover. So a company that keeps employees, retains employees, and there's not people coming in and out of the business all the time. Persistency of the group. So how long has the group stayed with one insurance company or one insurer? Or are they flip-flopping around different companies every year? Okay, that's a risk. Eligibility determination. Eligibility requirements could include a specified amount of time at the employer. So they could have to be there for like 3 months, 30 days, something like that, before coverage takes effect. Okay. Source of premium payment, so whether the plan is contributory, where employees contribute. So contributory, employees contribute. Non-contributory, employees do not contribute. The employer covers all the costs. Non-contributory plans are favored because they require 100% participation, which helps distribute risk and minimize the chances, of adverse selection. Because if someone comes in and it costs that individual money, they're more likely to be like, oh no, I don't want it, right? At the end of the day, the reality is that employers provide these benefits and cover the costs, but it's really built into their payroll structure. So it's not like the company is it's like, okay, well, we're going to give you health insurance, but that costs us $400 a month. So instead of paying you $400 more a month, we're just going to put it towards the health insurance. So it's all built in, right? It's all relative. So, but but people don't realize that, right? So they go in, they check the box, they're like, I got health insurance, not realizing that they're paying for it. It's not like, the employers don't give anybody anything for free. It's built into their compensation, structure. When they do their balance sheet, they include that in what it costs to have an employee. Okay. Prior claims experience. How's the claim history of the group? Okay. Are they filing claims all the time or not? What's the size and composition? Are they large? Are they diverse? Large, more diverse groups are stable and less risky. If they're smaller and everyone's older, that's going to be riskier to the insurance company than if it's a large group of different age ranges or younger people. Industry or business type. So some industries have a higher mortality and morbidity rate, increasing the group's risk. Like if someone works with like hazardous chemicals in construction, they could get hurt or get sick from chemicals, something like that. Okay. So group health insurance is designed to meet the needs of employers and their employees, offering several distinct features that differentiate it from individual health plans. Okay. These are differences in the contract, the cost, the premium payment methods, and eligibility requirements. Additionally, group plans often receive favorable tax treatment. So we're going to explore the features of this form of insurance protection. So group health insurance is usually provided by an employer or another eligible sponsor for its employees. Okay, the coverage agreement is the certificate of coverage that's established between the insurance company and the employer. So once it's agreed upon what plan they're going to have, the employer's issued there's a certificate of coverage. The employer, as a master policy holder, receives the master policy. Individual employees receive a conditional, I'm all over. Individual employees receive a certificate of insurance rather than a separate policy. Okay, so it's like group life. They get certificates of insurance, not a separate policy. So they're covered under the master policy. They get a certificate of insurance. They get a booklet with all the outlines of the benefits and stuff like that. So group health plans usually often offer more comprehensive benefits than individual plans with higher maximums and lower deductibles because the risk is spread out over a larger group. Okay. There's a limited window of time known as an enrollment period during which eligible members can enroll in the plan. A new employee is required to complete an enrollment card during the open enrollment period to sign up. So they have to sign up in the enrollment period, and if they don't, they may not be eligible for the same coverages because the insurance company is saying, well, if they waited, like why would they wait and then all of a sudden want it? they protect themselves against someone not wanting it and then being like, oh, I'm sick now, I want it, right? So that's adverse selection. Probationary period, there's typically a waiting period before becoming eligible for group health insurance coverage. Probationary period is called. So there are many features shared between group life and group health. One is eligibility standards for both groups and the individuals that make up the group. Premium payment methods are either contributory, where the employees contribute, or non-contributory, where the employer covers the whole cost. It's typically cheaper compared to individual policies. There's a predetermined benefit, meaning they're set and can't be selected individually. So the employer says, here's the benefit, do you want it? They can't go in and adjust the benefits. The underwriting is tailored for groups, so it's usually more liberal underwriting, easier to qualify for. And there's conversion privileges, which allow you to convert your group coverage to individual coverage if you leave the group. And there's pre-existing condition provisions, which outline how pre-existing medical conditions are treated under the policy. So to participate in the plans, an employer must show they have the ability to manage the healthcare programs effectively. This includes the ability to contribute financially as promised and to administer the plan appropriately. So if it's a non-contributory plan where the employees are not contributing and the employer is covering everything, then the insurer will probably want to see, hey, show us that you got the money and show us that you can actually handle getting everybody signed up for this. Right? Like, show us you got an HR department that's going to be on top of making sure everybody enrolls and all that stuff. Okay, eligible groups. So there's certain groups that are going to be eligible, and there's certain groups that won't be eligible. Okay, the common eligible groups are as follows: employers, trade associations, labor unions, creditor-debtor groups, lodges and similar organizations, multiple employer trusts, okay, which is a lot of many employers in the same industry. All right. So it's an employer, trade associations, labor unions, creditor-debtor groups, lodges, like a life insurance has like fraternal benefit societies, right? That's a lodge system. Okay. Now, negotiated trusteeships, Taft-Hartley trusts, these have to do with labor unions. Okay? All right. I'm texting something here. I had to just somebody. Okay. So employers are not allowed to pay directly to a labor union for group health coverage. All right. So if there's a union, it's a bargain between a union and an employer. Employers can't pay directly to the labor union. They make payments to a trust, and that trust finances the group health insurance for the union members. So instead of the employer paying directly to the union, the employer pays to a trust, and then that trust funds the union. So that's a negotiated trusteeship called the Taft-Hartley Trust. If you guys aren't sure with what I'm saying here, instead we'll have the employer, E, and then the union, okay? The employer cannot pay directly to the union, okay? They have to put the money in a trust, Taft-Hartley Trust, a negotiated trusteeship. So THT, okay? And then that goes and funds the health coverage for the union, okay? The union's a group of people that get together to get higher wages and benefits and stuff like that. So minimum group size for group coverage. The minimum typically is 10, okay? It can vary state to state, which you'll learn in your state-specific material, but 10 is the most common minimum. Temporary employees usually don't qualify. Okay, group coverage provisions. Okay, these outline several key aspects of health insurance plans for employees, including eligibility. So the group coverage provision and provisions offer, hey, who qualifies to participate in this plan? What's the eligibility period? So what's the time frame during which an employee must enroll? Minimum participation states the required number of employees who must participate in the plan. Benefits details the coverage and services provided to the insured. The limitations describes any restrictions or exclusions in the plan. Also, qualifications outline conditions employees must meet to be eligible for coverage. And there are master policy owner responsibilities. So the employer, as the master policy owner, is responsible for managing the plan and ensuring compliance with its terms. So employers may differentiate benefits based on employee groups as long as these distinctions are considered fair. For instance, an employer might give additional benefits to those who have attained specific job positions or salary thresholds, but you can't discriminate on people within a specific group. Okay? Predetermined benefits. So group health plans have predetermined benefits. Okay, these benefits are established by the employer in collaboration with the insurer based on benefit schedules and coverage limits. Okay, so for instance, group disability benefits are tied to an employee's position or salary. All right? Depending on how much someone makes, that'll determine what the disability benefit is. Someone's income doesn't really determine how much health coverage they get as much because, you know, it doesn't matter if you're rich or you don't make much money. Okay. And then accidental death and dismemberment benefits follow a similar structure based on predefined schedules. So that's like if you lose an arm or a leg, then they get a certain amount of money for it, something like that, or you die on it as a result of an accident. Typically, the more someone makes, the accidental death benefit might be larger than someone who makes less because there's more income to replace, okay? Individual eligibility. So as with group life insurance, group health plans impose specific eligibility requirements that employees must meet before they can participate in the plan. Common criteria include a minimum of 1 to 3 months, so 1 to 3 months working for the employer. Usually, it might depend on the state, and you have to be a full-time employee usually to receive a group health plan benefit. Also, employees age 65 or older who are still working must typically be offered the same health benefits. So eligibility period is a window of time during which an employer must elect to enroll in the group health plan. Typically 30 or 31 days of becoming eligible. If coverage is not selected in that period, the individual will need to apply for coverage on an individual basis, and a physical examination may be required before coverage is granted. This eligibility period helps reduce adverse selection. So if someone starts at a company, they might say, you got 30 days to enroll or 31 days to enroll. If they don't select it, then they might have to apply on an individual basis, and then they might have to do a physical exam and everything else because the insurance company will be like, why didn't you apply earlier, right? Okay. So contributory versus non-contributory. We've covered this a little bit. We're going to get into it a little bit more depth now. Group health plans can be structured as either contributory or non-contributory. Okay, so non-contributory plans, the employer pays the whole premium, and these plans typically require 100% participation by all eligible employees to reduce adverse selection, so everybody has to enroll. Contributory plans are where the employer has to contribute. So contributory plan is where the employee has to contribute. I get employer, employee, I know what they are, but I get the words mixed up just because they sound the same. So in a contributory plan, the employee has to share a portion of the premium cost, and they require 75% participation by eligible employees. So 75% of people have to participate in that. All right. The 100% need to participate in a non-contributory plan. So if the company that the person works for, the employer, is covering everything, the whole cost, everybody has to be in the plan, 100% participation. If the employee has to pay a little out of pocket, at least 75% of people have to participate. So the reason for this is, one, to protect from adverse selection, So it's a balanced risk pool. And then 2, to keep administrative expenses proportional to the number of coverage units. All right? Okay. So administrative expenses is proportional to the coverage and how many people are in it and stuff like that. If participation drops below the threshold in either of these types of plans, it can be terminated. So remember, non-contributory, the employee does not have to contribute. So you don't have to pay anything out of pocket if it's non-contributory. So non-contributory and contributory, they refer to the employee's responsibility, not the employer's responsibility. Because in a non-contributory plan, the employee does not have to contribute. In a contributory plan, the employee does have to contribute. Okay. Now, one of the advantages is lower cost compared to individual health plans. So there's a reduced administrative and selling expense associated with the group plans. Okay. Factors that influence group health premiums might include the size of the group. Okay. The larger the group, and the larger the group, typically the lower the premium might be, because there's a larger pool of risk. Right? So it's less risk to the insurance company to insure 1 million people than it is to insure 10 people. The group's claims experience. So if the group doesn't file many claims, then they're going to get cheaper premiums. If they file a lot of claims, the premiums are going to be higher. And then the ages of the individual group members. So these all kind of work together. But if you have a group of 1,000 people that are over 50 years old, those premiums are going to be much higher than if you have a group of 1,000 people who are 30 years old. Because the 30-year-olds have a less chance of having to file a claim and get sick and have some really tough illness or disease or something like that. Okay, premium rating. So this is going to, up here, we went over some things that can influence group health insurance premiums. We're going to dive into that a little bit more. So group health premiums are determined by several key rating factors. One, the average age of the group. We covered that there. So higher average age leads to higher premiums. Waiting period for disability benefits. So a shorter waiting period on disability benefits increases premiums because the insurance company has to pay out sooner, and it's really less time for the person to heal up and have that disability magically not be there anymore. Then disability benefits indemnity period, which is the longer the indemnity. So indemnity period is the benefit payout period, right? So the longer the benefits pay out, the more premiums. And then occupation, more hazardous occupations result in higher premiums. So if someone, works at home, if everybody works at home and they're in their own office, then not super risky. But say someone's like high risk job, like if they have to drive all over town every day, that's riskier, right? They could get hurt in an accident, something like that. You can't get in a car accident sitting at home all day. Now, there are some stipulations for small employers. So a lot of these things that we've just talked about cover larger employers, but there's some specifics for smaller employers too. So we're going to cover availability of coverage. So insurance companies are authorized to offer group health insurance policies to small employers, so small businesses, with 2 to 50 employees to provide coverage for their workers. If they have fewer than 20 employees, okay, the employer can use, or working each day during 20 or more calendar weeks in the current or previous year, small employers with fewer than 20 employees can use Medicare as their primary payer for employee claims. So if they have fewer than 20 employees working each day during 20 or more calendar weeks in the previous calendar year, they can use Medicare as a primary payer for employee claims. So Medicare will help. Employers with 20 or more employees meeting the same criteria use Medicare as the secondary payer for claims. Okay. Funding of group insurance. Okay, funding of group insurance. In recent years, businesses, have increasingly explored alternative funding methods for group health insurance as a way to manage costs and improve cash flow. Traditional group insurance model involves the employer paying premiums while the insurer is responsible for paying claims. So the employer pays premiums traditionally, right? The company pays the premiums for their employees, then the insurer pays the claims. But with the rising cost of healthcare over the last couple of decades, comprehensive coverage is more expensive, which has prompted employers or businesses to seek new options. So there's a modified fully. So what this is saying is that typically the company covered all the costs, and then the insurance company would cover the claims, right? But now it's becoming more expensive. So they're looking for other ways to provide coverage. So there's some alternatives here for managing the costs. These are typically for medium and large employees. Okay, one modified fully insured plan is called a premium delay arrangement. So this allows the employer to defer premium payments beyond the usual 30-day grace period, extending that grace period to 60 or 90 days. There are also reserve reduction arrangements, which is in this plan. The employer is allowed to keep an amount for the annual premium, from the annual premium, that matches the claim reserve. We covered reserves in a different video, which represents the fund set aside to cover expected claims. Okay? So the employer can retain some of the premium to match the claim reserve. And this is funds set aside to cover expected claims. There's also a retrospective premium arrangement. So the insurance company might collect a provisional premium at the beginning of the year, but may adjust at the end of the year based on actual losses. So if claims are, they may say, hey, at the beginning you have to give us a provisional premium of however much money. At the end of the year, if the claims are lower than expected, you might get a refund. If the claims are higher, then you might be required to pay more. Okay. So next is a shared funding arrangement. So a shared funding arrangement. In a shared funding arrangement, the employer takes on a portion of healthcare expenses by self-funding claims up to a specified limit. Okay. So the employer will actually fund the claim. So the employer selects a deductible and covers the cost for claims up to that limit. Once that's reached, the insurance company takes responsibility. All right, it's a shared funding arrangement. The employer covers some of the healthcare expenses. In a minimum premium arrangement, the employer self-insures for routine and expected claims, paying out-of-pocket up to a set amount. Now, the insurance company will cover costs that exceed that threshold, which protect the employer from crazy claims, unusually high claims. Now, there's a 501c9 trust. It's a funding vehicle for employee benefits. So contributions to the trust are tax deductible, similar to premiums paid to an insurer. The trust must meet the following criteria. So you can put the money into some companies can put the money into a trust, and then that will be used to fund the benefits. So it has to provide eligible benefits only. Its only purpose is to offer benefits to the members or beneficiaries. And it must be controlled by one of the following. So the membership, an independent trustee like a bank, or another fiduciary for the members. Fiduciary is someone who's financially responsible for the members. So it has to be controlled. The trust has to be controlled by one of those three things. Okay. Self-funding arrangement. In a self-funding arrangement, large employers take on the full responsibility for funding healthcare claims. This can involve the employer or the company paying all the claims. It can involve them having taking care of administration of the plan and assuming the risk if actual claims exceed expected amounts. Small and medium-sized employees typically avoid fully self-funding due to the risk of severe claims. Okay, so smaller and medium-sized businesses usually aren't going to take on that risk. But the larger the company, the more people that are there, the less risk that is, because there's going to be people who don't utilize the coverage. So some smaller employees self-fund basic medical expenses while purchasing insurance for major benefits. So maybe there's minor stuff, the smaller company will cover it, and then they have a plan to cover the bigger stuff. Large employees that have thousands of workers are more likely to self-fund their healthcare plans. So there's also ASO contracts. These are administrative services only. So an administrative services only contract, it allows the employer to purchase certain administrative services from either an insurance company or an independent third-party administrator without transferring the risk of claims. So what happens here is there'll be a company that helps administer, essentially like they handle all the back office stuff. So they help with the claims administration, COBRA, which you guys will learn about, prescription drug card services, and communication with employees. Okay, so they may say, hey, we're going to handle some plans on our own. We're going to have a self-funded plan, but we're going to contract you out to handle the administrative side of it. Okay. That way they don't have to handle all the administrative stuff. Okay. Next, we're going over conversion privilege. So in a group health plan that offers medical expense coverage has a conversion privilege. So if you leave your employer, then you have the ability to convert the group certificate into a personal medical expense policy with the same insurer. Key points about this conversion include: 1, guaranteed coverage. So you can't be denied coverage even if you become uninsurable. However, the insurance company may assess the individual and apply an appropriate premium, whether standard or substandard. So you can't be denied coverage if you leave, but they might be able to charge you more. Okay? And you have to apply within a certain time frame. It's usually 31 days, depending on the state. But during this period, the individual continues to be covered by the group plan, regardless of whether they choose to proceed with conversion. So if someone's terminated, then or laid off or leave voluntarily, you can't. This isn't for people who are terminated for cause. But if someone leaves the company, they can convert. But they have a certain amount of time to do it, and they might have to pay more. Okay, it's generally available only to employees who are actively covered by the plan during the previous 3 months. So you can't join, have coverage for a month, and then leave. You have to, and then keep an individual plan. You have to have been covered for 3 months to be eligible for the conversion. Okay. Excess benefits. So converted group health plans may not provide benefits that exceed those offered under the original plan. Offering overly generous benefits could lead to overutilization of the plan. So if someone leaves and converts from a group to an individual, that individual is not going to have more benefits than the original group one. Okay? Now, the insurance company can decline renewal of a converted policy. So you can convert it, but when you're up for renewal, they may be able to cancel that policy. For overinsurance, so if someone's filed too many claims, they can deny renewal of the individual plan. Or if there's been fraud or material misrepresentation, they can decline that. Or if the insured is eligible for Medicare, they can decline it. Okay. So there's a big law. It's called HIPAA, but this is the Health Insurance Portability and Accountability Act. So HIPAA enables millions of American workers and their families to maintain and transfer health insurance coverage when they switch jobs or experience job loss. It also establishes privacy and security protections for individuals' health information. HIPAA is big in insurance. There's a HIPAA privacy rule, which ensures federal safeguards for an individual's health information and provides patients with various rights concerning their personally identifiable health data. So HIPAA privacy rules are pretty much, it's like you can't just go share someone's health information, okay? Now there's a HIPAA security rule, which implements technical safeguards to protect electronic protected health information, ensuring its confidentiality, integrity, and accessibility. So you have to have certain safeguards to protect someone's information if it's stored electronically. Okay. So we got a couple more pages of stuff here, and then we're done for group coverage for now. HIPAA requirements, continuation of coverage. So companies with 20 or more employees must permit former employees to continue receiving health coverage from the employer's group health insurance plan in a continuation of coverage. The rule mandates that group health coverage cannot base eligibility on factors such as medical history, health status, disabilities, claims experience, or genetic information. Okay? So you can't discriminate based on certain things. Pre-existing conditions. This restricts a new company's health plan, new employer's health plan, from excluding coverage based on pre-existing conditions. So they can't exclude certain coverage based on pre-existing conditions if someone already had something when they joined up. Also, healthcare providers must comply with requirements regarding the disclosure of protected health information. Policyholders must be notified of information practices every 3 years. Immediate coverage. If an individual leaves one company and starts working at a new company that offers group health plans, they're eligible for coverage upon hire. All right, so if they leave one company and start working somewhere else that has group coverage, they're eligible immediately for that coverage. Denial of policy renewal. HIPAA specifies that renewal of group health policies can be denied if the participation or contribution requirements have been breached. Sorry, so they can the renewal can be denied if contribution requirements or participation requirements have not been met. IRA withdrawals. HIPAA states that 10% excise tax on early IRA withdrawals does not apply if the withdrawal is used for medical expenses exceeding 10% of the individual's adjusted gross income as of 2019. So if you have an individual retirement account or an IRA, there's a 10% excise tax penalty on early withdrawals, okay, if you withdraw before a certain age. But this gives an exception, okay, if it's used for medical expenses that exceed 10% of the individual's adjusted gross annual income. So say their adjusted gross income is $70,000, and then the medical expense is, 10% of 70,000 is 7,000. If the medical expense is $10,000, an early withdrawal from an IRA to cover that will not impose the additional 10% tax. Okay. Multiple employer plans. So under HIPAA, multiple employer plans, which we covered just a minute ago, and multiple employer welfare arrangements are required to be guaranteed renewable, except in cases involving fraud or intentional misrepresentation. HIPAA regulations, the scope HIPAA regulations are applicable to all group health plans with the exception of disability income plans. Okay, so disability income plans, HIPAA regulations are not applicable to. Okay, pre-existing conditions is a big one. HIPAA's changed how pre-existing conditions are handled under group health plans, excluding disability income plans. HIPAA portability rules allow individuals transitioning from one group medical plan to another to reduce or eliminate exclusions for pre-existing conditions in the new plan. As a result, individuals are eligible for coverage upon hire when switching jobs or group plans. So when you switch group plans from company to company, pre-existing conditions are not excluded or are excluded, and coverage starts when you're hired. So under HIPAA, pre-existing conditions are defined as health conditions that existed, were treated, or were diagnosed within 6 months leading up to the employment. Pre-existing conditions may be excluded from coverage for up to 12 months for regular enrollees and 18 months for late enrollees, those who elect coverage after their initial eligibility period. Okay, so regular enrollees, a lot of policies don't do this, but this is just something HIPAA says. Pre-existing conditions, if you are not transferring from one company to another and you're just brand new enrolling in group coverage, they might be able to exclude pre-existing conditions for coverage up to 12 months if you're a regular enrollee, or 18 months if you enrolled in the plan late after that 30 or 31 day eligibility period we just talked about. So portability, as we're saying here, portability rules, what this has to do in the context of group health coverage, it refers to the ability to switch from one health plan to the other. So to port it over. Think of transport, so portability. That's just the term, the industry term. This occurs when changing jobs or when an employer switches insurance providers, okay? Next, we're going to go over creditable coverage. So creditable coverage under HIPAA reduces the waiting period for pre-existing conditions when transitioning between health plans. This previous coverage counts if there's not been a break in coverage for the last 63 days, okay? So creditable coverage reduces the waiting period for pre-existing conditions when you transition from one plan to the other. The 63-day period starts when the individual's prior coverage ends and concludes when the coverage under the new plan begins, or if sooner, when the group's waiting period for eligibility starts. So essentially, you have 63 days from switching from one group to the other to be considered for that provision, where it just kicks in right away and it does not exclude pre-existing conditions. All right? So like if you leave a company, you have 63 days to get something else going based on these rules at another company, with another employer. Okay, other group health insurance coverages. So group health insurance plans provide a variety of coverage, including medical expense insurance or health insurance, disability income insurance, and accidental death and dismemberment insurance. So these types of coverages can all be offered through group plans. So you can get group health, group medical expense, group disability income, or group accidental death and dismemberment. Okay? There's some key characteristics of group health insurance. Multi-state coverage. For group health plans covering employees in multiple states, the plans generally governed in accordance with the laws of the state where the master contract is established. So say the company's in Florida, but they got people in 4 other states. The plan will be governed in accordance with Florida's state health insurance laws. Additional group-only coverages. Certain coverages like vision care and dental care are often available through group plans only. Combination plans, a group basic medical expense plan, may combine 2 or more coverages like hospital and surgical benefits, or focus on a single type of coverage like hospital expense only. And you get equal coverage for older employees, so people age 65 or older who are still working must typically be provided the same accident and health benefits provided to younger employees. So I hope this helped you guys learn a little bit more about group health plans. My goal is to help you pass your exam on the first try. I know I'm kind of sitting back here all lazy, but that was a lot to read. So if you would like a free study guide, please click in the link in the description of the video. If you would like to learn about working with me selling life insurance at my agency, just email me at the email in the description of the video. And you don't want to miss this next video coming up here, because I want you all to pass your life and health or health insurance exam on the first try. And it all really starts with this next video coming up. You're going to see it right there. Thank you so much.